Hello, everyone. Let's get started. Compliments to Liz for always ending the song at the exact precise time every time. Thank you. On behalf of Haynes and Boone, AEGIS, Energy Risk, and EnerCom, welcome to Season 4, Episode 2 of the Energy Tracker. My name is Jeff Nichols. I'm a partner in the Houston office of Haynes and Boone and co-chair of the Energy Practice Group. I'll be the moderator of today's call. These calls are broadcast live on the second Tuesday of each month from 9 to 10 a.m. Central Time. This call is being recorded on November 10th, 2020, and will be available for replay by EnerCom at oilandgas360.com and by Haynes and Boone on our Energy Reports and Surveys website. If you are listening to a replay of this and would like to attend the live calls or would like to send questions or suggestions, please email me at jeff.nichols@haynesboone.com. We can send you a calendar invitation with the connection information. As always, please email Craig Grahman with any complaints. The speakers are shown on the next slide. First, Matt Marshall from AEGIS will discuss pricing and markets. The pressure will be on to explain exactly what happened yesterday. Then Aaron Vandeford from EnerCom will discuss activist investor developments and valuations in M&A. In particular, we've asked him about the bid-ask spread that seems to be sticking with holding back a lot of these transactions. Then our special guest star, Fraser Murphy, will be joining us from our Dallas office. Fraser's been in the trenches on several of these oil and gas bankruptcies, and he'll discuss one of the interesting issues that seems to keep arising, which is the toggle plans. Standing by will be Craig Grahman and Buddy Clark, who, if there's time, will give us maybe a sneak peek at the October bankruptcy reporter, which we will expect to be releasing in the next few days. And finally, thanks to Liz Felicidario and Reem Abdelrazak for running the technology for today's call. So now I'll turn it over to Matt. Matt, what happened yesterday?
Hey, thanks, Jeff. Well, it was a good day for an oil producer for sure. You know, you love it on a Sunday evening whenever you see prices rising 10% on the day. So I hope that everybody who needed to hedge volumes had their counterparties in place and were ready to trade because it was a good day. I'm going to switch over to sharing my screen here real quick. I want to go fast because I know Haynes Boone and EnerCom got a lot of good stuff. I want to get to it. So I'm going to go at a brisk pace because we need to cover what happened with crude. And then gas has just had a hard time lately. So I want to show our outlook for next summer because it's a lot better than what's happened in the last couple of weeks. So first of all, for crude oil, you can see that, good day on Monday, and the prices have been holding today too. But really, you're really just back to the mean of the last couple of months. I mean, we had this mess here and then this recovery, but we've seen a lot of volatility since. And this is a big reason why we have been recommending more aggressive hedging structures in the near term, is because we expect a lot of that volatility to continue. So yesterday, crude got caught up in good news about a vaccine. That looks like it would be more effective than most people thought. And the reason that's important for crude, and first of all, it affected everything. It affected everything really associated with economic expansion. It was equities, it was base metals. We hedge base metals, and those were up during the early in the day too. So anything associated with inflation, economic expansion, and crude was part of that. And the good news for crude, though, was that as soon as you start to see a vaccine get effective and proliferate through the population, you might start to see some of those last holdouts of fuel consumption, namely in aviation, start to recover. And that's a really good story. And I'll show you what that means for the global supply-demand balance here in a second. I'll say also what happened yesterday. Lots of hedging activity. I was just looking at some numbers from this from our back office, and it looks like yesterday was the highest volume we've seen among our clients. And our clients produce over 3.5 million barrels of BOE a day. That was the biggest day in the last 3 months. And it was also interesting that a large percentage of our clients were interested in hedging yesterday. So that's some real-time data that we got from just overnight. All right, so this is also where you saw them hedging. So you see in Cal 22 here where some clients and some just in general in the industry had been looking for opportunities to hedge Cal 22 because maybe your volumes had been low. But you saw yesterday really took advantage of a rise in the curve to where they were hedging a lot of 22 and also put on second half of 2021. So we're good to see great data to put on some extra protection. So here's what it means for the global supply-demand balance. If you've got this vaccine that possibly could turn around the way people travel, the way to read this chart is all the columns here are supply. And so you've got non-OPEC supply plus OPEC NGL. So that includes the U.S., Brazil, Canada. Then you got Russia on top of that, and then on top of that is OPEC supply. And then these gray areas are really important because this is spare capacity, OPEC spare capacity. And then the light gray are spare capacity that is not as likely to come on in the near term. And put it against that are demand figures in the lines. And so you can see as you progress through time, as demand starts to recover, demand gets up to the top of that spare capacity when we get toward the end of 2021. Now we put this red line in there. You got OPEC's outlook, you got EIA's outlook for demand growth, and then on top of that, we put a scenario where what if you see some further recovery in travel? And it looks like just based on this scenario, where you get this increase of about 2 million barrels a day of more petroleum demand, it looks like by the end of 21, with that potential vaccine effect, is that you could be running out of spare capacity among the OPEC nations plus Russia by the end of 2021, and that totally changes the way that the supply demand balance would look in 2022. All right, so let's just look at some of the other things that are affecting crude oil right now. What I would point out, this is our factor matrix. So if anything if we think something is priced in, we put it low on the chart. If we think something is a potential surprise, put it high on the chart. Here's what I want to point out to you. What if this thing goes away? What if we see a recovery in petroleum demand? Suddenly you don't have this big bearish force on the left side of the chart. And what you're left with is, are we going to have enough capacity in spending in the capital markets, so debt and equity, and also will the oilfield services sector be in a situation where it can respond with more supply, where in 2022, if we need that supply, will we be able to bring it into market? And we're wondering about that. The other things to watch out in the near term are OPEC cuts. They're meeting at the end of November. You got to see they saw the same information about this vaccine that we did. So you got to think that they're wondering about, are their concerns about demand growth maybe a little bit lessened, and would they make a different decision at the end of the month? So some near-term things. All right, so here's how you trade this. And I just want to point out, this is not for everybody. This is a more aggressive way to hedge Cal 22, but I want to point it out to you. First thing I want to say is this is historically how the WTI CMA contract has settled going back, for the last 20 years. This is the price formula that most producers receive. I marked in red dots the times when it settled below $25. So April settled below 25. Before that, you got to go back to 2002. That there's good fundamental reasons for this. You start seeing prices drop that low. People want to shut in their oil. There's other fundamental reasons for it too, but we can just see, not that the future will follow the past, but it doesn't settle below 25 very often. So if that's the case, and we see this support around $25, there is a hedging strategy that has been really vilified over the last several years for good reason sometimes, and that is a three-way collar. So let's explain what the three-way collar does. And I talked with our trading desk, and I got these prices as of this morning. So everything you see here is as of this morning. So in Cal 22, I believe the price, well, I'll look it up for you. I think it's around 43.5 this morning for Cal 22. So here's the way a three-way collar works. You put on three different instruments that allow you to come to zero net cost. The way you're going to do this is you're going to sell a call option. You get money for that. You're going to sell a put option. You get money for that, and then use those two premium that you earned to buy a put option, and that's right there, right here. So what happens is when you put this type of construction on, your price is capped, and as of this morning is like 54.55. All right, so you don't make any more than that. I think most producers would be happy at about 54.55 right now. You get total protection down to $35 the way we arranged this one this morning. The problem becomes, and this is where you have to really pay attention to it, is you don't have complete protection down below $25. In fact, what you get is whatever the market price is plus the spread between these two things, which in this case is $10. So if this is something that you feel like you're comfortable with, just give me a call afterwards. We'll talk about it. The time to use three-way collars is when prices are low, not when they're high. And so this is one of those that could make sense for some people, depending on what your current portfolio looks like. All right, that's oil. Natural gas. Natural gas has just been beat up. It's been beat up lately. A lot of the bullish things that have been available to come into the market and get priced in really did get priced in during September and October. We had some early winter failure in the weather forecasts for the last couple of weeks, and gas prices have just really come down as a result. So what that means is, and these are the different parts of the curve. So this is prompt month. The winter is the part that bothers me. That's winter. You can see it drop down to here, had been up here. And then next summer, price, or put it in the light blue, it had seen a rally up to here and now come down to here. So I don't like seeing that, but here is the silver lining on this. Prices have probably dropped down below what most producers' break-evens for new drilling would be. Okay, so what that means is that there's less of a possibility that new production would suddenly arise, except for some things associated with some infrastructure additions coming up. But you wouldn't expect a whole lot of new D&C activity where prices are right now. And our point of view, and I'll show you in just a second, is that in 2021 you need to see prices either go up to destroy some demand or to call up some new supply, because we're going to be undersupplied. All right, let's take a look at that. Here's a big thing that surprised the market lately, and it's been widely ignored in the last couple of weeks, and that is LNG flows. Back before COVID, you saw numbers around 9 BCF a day. Recently, we've been doing about 10 and a quarter. So over where it had been before COVID. If that keeps up, this market cannot tolerate that, and we will have a problem with gas scarcity sometime either, say, late winter or in the summer. In fact, our base case was that we would do 8 BCF a day. That would be the demand. But you can see, like, our more aggressive cases go up to 10 BCF a day, and we're already doing more than that. So if that keeps up, what would happen? So this is just natural gas in storage for each year, and we're starting the year up around almost 4,000 BCF. And the farther it drops into by the end of winter, the more bullish it is, and the less it grows by the end of next fall. Going into next winter, the more bullish it is. So here's our base case where we take a mild weather assumption. And the last six years have really been fairly mild. Actually, some of them had really, really mild. But if we say that LNG doesn't achieve those levels that we just showed before on the low end of our cases, and you get a mild winter, and production holds at about 89 BCF a day where it is right now, you have a hard time getting back up to the amount of storage that the market would want. But it would be, it wouldn't. This is not exactly a real bullish case. What is a bullish case is if you get a little bit colder weather, not a cold winter, just a little bit colder, and just not as mild as it was the last couple of years, and the LNG flows are higher up on our chart, then you have a real problem with not having enough supply going into next winter. And if LNG keeps doing what it's doing, this is scarcity. This is a situation where you either need some more supply or you need to destroy some demand with high price. So that's where we are in natural gas. To round it all out, what we'd say here is that some of the things that had been priced in recently are expectations that production may start to tick up higher, and so that has had to put a little bearish effect. We think that the market is starting to realize that the LNG flows are going to be high, and so you can see some kind of upward slope here. We've got a bullish point of view now. Just as prices have retreated, we think there's room for it to run. Start of winter might be a little rough though. So that's what I have for you today. Certainly, if you have any questions, let me know. And with that, I'll toss it over to Aaron.
Hey, thanks, Matt, and good morning, everyone. I wanted to spend a little bit of time with you this morning looking at really the capital markets, where they are today. We'll take a quick look at earnings, some of the things we heard about, and then spend a little bit of time looking through the lens of valuation at the M&A space, as that's certainly top of mind for most folks, and we heard that in earnings calls, as well as where there may be opportunity and why some deals are getting done. And we saw a couple deals yesterday, one being the High Point Bonanza Creek deal, and as well as Lillis on an auction deal. We'll take a quick look at both of those. But really just kind of covering earnings here for a second. A lot of focus on, where cash flows are ending up. A lot of looks into some of the deals that we've seen already, the Devons and the WPXs and the folks that have announced combinations. And are these assets performing as they expected? And I think, some of those guys certainly came out with surprises to the positive side. And in general, we've seen some positive earnings notes. Certainly a lot of investor focus on maintenance capital, activity levels, certainly in there. And then obviously liquidity, borrowing base redetermination season. I know Haynes and Boone will cover a little bit of what they saw in that. And so Nothing really too surprising there on the earnings front, but it was another opportunity to check in with companies. And so if we move to the first slide that I have, we took a update to where capital is being spent. And so if you recall last month, I had the same slide. That initial public offerings was 0. We actually got our first one. It came out of Canada. It wasn't here in the US, but it was out of Canada. It was Topaz Energy, and it was a spin out from Tourmaline in Canada, and it was focused on minerals and infrastructure. And so that'll be one of the themes that we look through here as we think about where is their money and capital for this space. That minerals group continues to be a shining place where capital wants to be put to work. And so to create a small cap minerals company and there to be a market for it, I thought was an interesting note, and it's done well. So it's increased in its price since IPO. And if we take a step one further down onto the follow-on offerings, we're up to 1.2 billion. We've almost doubled what we've put to work in 2019 from an equity offering, but most of those have been focused on minerals. So you've got Brigham Minerals, who's come to the market twice in 2020, and one of the recent ones was EQT in its acquisition of Appalachia assets from Chevron for $735 million. As a part of that deal, they actually raised $310 million in new equity, and so that was what looked like a more traditional, what we've seen in the past, acquisition of assets with the use of capital market support. And so natural gas, we've continued to talk about on these calls as a positive in the light of the capital markets, despite, we haven't quite seen that uptick. And so, Matt outlined very nicely, there is a lot of potential on natural gas. And I think we take a longer term view in the capital markets. Though 6 to 12 months doesn't seem that long of a view, there is some capital being offered there. We take a look at the bottom of this chart. We've got the M&A announcements, and so we've ticked up. We're quite short on dollar amounts compared to years past, but we have seen some deals continue to get announced and planned. But as Jeff alluded to in the beginning, there is a bid-ask spread, and it's quite significant. And so we'll spend a little bit of time here in the next few slides exploring what that looks like. And so if we move to the next slide, this is an update on representative transaction values from 2017 through Q3. And so this is a reserves-based metric, and it's dollar per BOE. And so we can see there between that $5 and $10 mark is kind of a normal spot in this previous downturn, or in this prolonged downturn, I should say. We've in 2018 got a couple deals that were in excess of that, but we're certainly well off those marks, and it seems to be kind of stabilizing, though we're off the Q1 20 lows. And so folks are focused on production, not necessarily reserves, and folks are only going to sell if they have to, and have to's in quotes right now, if their capital is in a position where they would like to exit or receive cash. That's really where a lot of these deals are getting done, and it's not what we're seeing as healthy M&A activity or transactions. And so if we take a look at the next slide, it's the same time period that we're looking at for the reserves, but it's focused on production. And again, even more so, we're off of this dollar per flowing barrel of production number and metric down to about $10,000 per flowing barrel equivalent per day. And so this is a metric where we can take a look at, there's a lot of ways to take a look at valuation, obviously reserves, production, cash flow. We're going to take a little bit of a comparative look of valuations using this metric to where companies are trading as well. But there is money out there. Deals are getting done. But the money has decisively said, we're not going to chase. We feel like there's time there. We feel like there's still opportunity, and we're not going to miss anything by waiting. And the operator or seller in this case is saying the same thing, saying, look, there's more to the upside if we can build runway, if we can extend runway, if we can navigate different channels, there's a better time to sell. And so that bid-ask spread, we're not getting a lot of deals done. The deals that are getting done are more out of distress instead of that healthy. And so if we take a look at the next slide, from an enterprise value to production basis as of yesterday, and I wanted to make sure that we took in that last little uptick that we saw yesterday and Monday, which was great to see. There is quite a bit of difference between our large cap, mid cap, and small cap. And so let's just focus on the left-hand side of this slide for a second. What I defined as large cap is $6 billion market caps or greater. Mid cap, I put between that $1 and $6 billion market cap, and less than $1 billion being the small cap group. And as you can see from a valuation perspective, on this specific metric, the small cap to mid cap doesn't have a whole lot of a difference, but certainly once you get to a mid cap to a large cap, there seems to be a tremendous difference in valuation on those incremental barrels of production. And so as we take a look at where the gas names are, that's the red column, this is really what the market is taking a look at gas names, and they're saying, you guys are different than really our traditional oil or diversified producers, and they're valuing them differently, just the same way that the market is valuing minerals companies differently. And so if we take a look at that transaction value from the previous slide of right around 10,000 per flowing, there's a significant disconnect from that to even where gas names are trading to where small cap names are trading. And so if I'm a small cap producer that doesn't have to sell at a tremendous discount, this visualizes some of that bid-ask spread, even on where folks are trading today. And I can tell you from a lot of our clients, small cap names on through to large cap, they feel like they're undervalued. And so if I'm having to sell at 10,000 and I'm trading at 24, there's got to be some sort of reason or catalyst to get that done. So if we take a look at the next slide, we really take a look at this same group, but really on a price to cash flow for 2021 estimates from analyst estimates average from Bloomberg. And this even tells more of a story where gas is different than a lot of the other names, but really this large cap surety of cash flows and efficiencies is looking different than a small cap producer where there may be more volatility, as Matt was talking about, in prices. There may be more of an ability to hedge as you have more cash flow and production. And so, you know, the trap that folks kind of fall into here is that size matters, and certainly size provides opportunity, but really what we're saying here is cash flow matters. And so there are still some bright shining stars in the small cap group that have figured out some of this cash flow and its runway, that are able to achieve some more premium type of valuations. And so it's not all lost being a small cap company, but it certainly is one of those things where you need to be talking about your story and how you can build runway and cash flows. And so on the next slide, if we take a look at some of the sample M&A deals that we've seen, why they may be getting done, and some of the valuations associated with each of those, we might provide some context for future deals. And so the first one here on the left, announced yesterday, Lillis announces Ameredev, Texas winning bidder for substantially all of its assets as a part of Chapter 11 process. So that was a deal. Now it's not been
Well, it seems like Aaron is awfully stoic in his discussion of the M&A transaction valuations, and appropriately so with everything that's going on. So while we wait to reconnect, Aaron, maybe Fraser, are you ready to go?
Yes, I can. I think let me get my screen ready, Jeff, and then I should be ready to go here in just a second. Okay, Jeff, I'm in good shape.
Very good. Take it away. Thanks.
Okay. Good morning, everyone. Sorry about the technical glitches there. As Jeff mentioned at the outset, my name is Fraser Murphy. I'm a partner in Haynes and Boone's restructuring section. I'm based out of the Dallas office, and as Jeff said, I've spent the last few years in the trenches on many of these oil and gas bankruptcies and out-of-court workouts that we're seeing. And so we thought it would be a good topic to cover this morning, something that we're seeing a little more frequently, which is the use of a toggle feature in Chapter 11 plans. And so you may see this referred to as simply just a toggle feature, or parties also referring to it as a toggle plan. And what this means is it's simply a Chapter 11 plan that really provides for two potential outcomes. And that first outcome would be a sale of substantially all of the company's assets, or secondly, it would be a traditional restructuring of the company's liabilities that you would typically see in a Chapter 11 process. And the path that is pursued depends on whether the lenders exercise this so-called toggle right. And what that does is it shifts the plan from a sale to a traditional restructuring. And so to outline kind of what that scenario looks like, we know that there are active buyers.
Fraser, I think we lost your audio. Can you hear me? Okay, Fraser, if something's wrong with your audio, sounds like my audio is coming through. Craig, are you, would you like to step in while we work?
I'm happy to go ahead and cover the kind of what we're seeing now that we're in the middle of borrowing base redetermination season. And as you know, last month when we had this call, I discussed the results of our borrowing base redetermination survey for the fall. That survey was run during September in advance of the fall borrowing base redetermination season. Had a number of interesting findings, but the key finding is that most respondents, both producers and lenders, expected borrowing bases to decrease slightly in the 10 to 20% range or stay flat. So that survey showed results not as dramatic as what our spring survey predicted, still not what most producers have the ability to deal with right now. But now that we're currently about halfway through fall borrowing base season, we thought it'd be worthwhile to check in and see how things are going and circle up with several energy bankers to kind of see what they're seeing in the market, and some producers as well with respect to the redeterminations they're working on. Now, keep in mind that the tougher credits typically get handled on the later end of the season, or often even get punted to a date past the sort of normal traditional borrowing base redetermination season. So, and this goes for a number of times, not just sort of the deep distress times we're dealing with right now. But here are some things we've learned so far. In the game of chicken, that is distressed producers versus energy bankers that need to address the distress, the energy bankers by and large are the first to blink, or at least they're the first to show the willingness to kind of kick the can down the road. We haven't seen, as far as I'm aware, any sort of borrowing base drops that have resulted in a precipitous event like a bankruptcy filing or some sort of other kind of foreclosure posting or something along those lines. So far, to the extent that there have been decreases, they've either been managed in a more consensual manner, or have been just parties kind of at a standstill as far as what they're going to do with it. And bankers do have a lot of things pressuring them to exercise this patience right now and to kind of kick the can down the road. But by and large, bankers have shown that they don't want to own and operate the assets of oil and gas companies. This means that foreclosure is not a real practical option for them, even though by and large, they have pretty robust liens and security interests with respect to the assets of these companies. This also means that bankruptcy is not an option, because when you're the fulcrum security, as many of the reserve-based lenders are for these distressed credits, you're likely end up being the owner through a bankruptcy debt to equity restructure. And for the most part, the debt to equity restructures have been how at least the majority of the bankruptcies have been resolved, and how the exit has happened. The asset sales in bankruptcy, while there have been some notable ones, including some of the ones that like the Ameridev transaction that Aaron mentioned earlier, the asset sales in bankruptcy have been few and far between relative to the actual debt restructures that result in different debt holders in the capital structure ending up with equity. Another reason why bankers have been exercising some patience is there is a perception that this is the bottom of the this was for sure punctuated by the COVID developments and the vaccine developments of yesterday. So I think many would say that as of yesterday, we have sort of the most reliable light at the end of the tunnel that we've had since this started. But the reality is the real momentum is several months away, and the world is still having to triage against the latest wave of COVID. So things will get better. I think most, especially after news of yesterday, believe that, but it's just not now. And so many feel like we're sort of at the bottom of the market. We might be at a bottom for a little while here, and are hopeful that things will get better in the future and make dealing with these distressed credits a lot easier. The losses will be severe, is another reason why bankers don't want to be too aggressive right now. Even if they don't have to own and operate the assets, banks will take a big hit if they move now. Many are expecting losses regardless of when they make the move, but they don't see a lot of reason to act at this moment in an effort to try and mitigate losses. Also, some bankers have saying that while they've received offers from vulture funds or other investors to come in and make offers for RBL portfolios, those parties looking to buy out portfolios haven't showed a willingness to pay enough to make it worth it for the banks at this point to cut their losses and run. Also, sort of one other kind of final factor that's really resulting in this game of chicken that the banks by and far are losing right now in the borrowing-based redetermination season is that no one's really forcing the banks to do anything. The regional banks overweight on energy have already been punished in the public markets for it. The market has already kind of priced into their own stock prices, priced into those bank stock prices, the fact that they have these distressed RBL portfolios. And even with bad energy portfolios, most banks right now are stable enough that the drag from the energy portfolio is not really running the risk and making them go under on a larger scale. So that hasn't forced them to take more drastic actions with respect to their energy portfolios. And also the government regulators haven't really put any pressure, as far as we've seen, at least explicit pressure on the banks with respect to these RBL portfolios that are distressed. Of course, we have executive administration changes coming our way in January, and with any kind of change in leadership, there could be a change in policies and approaches of regulators. So we'll have to see what happens there. But as of right now, based on market intel, we don't believe that there's been a whole lot of drastic action with respect to the fall borrowing-based redetermination season. Certainly haven't seen any bankruptcies motivated solely by a drop in a borrowing base or a deficiency. There's more to come, and we're at a bottom, and obviously other events could happen. But at some point, bankers and their producers will have to address their debt issues. And while a dramatic improvement in the market will help, it won't be pain free. Market moves like we saw yesterday won't cure every one of the producers' issues. Producers, even once we get into recovery mode, will still have high debt, and many of them, due to market forces of this year, have set themselves up for either declining or at best flat production volumes as we head into recovery. So the key questions on that ultimate resolution are: number one, when will it happen? And number two, what industry participants will be willing to jump in and seize opportunities to make loans and take out distressed RBLs, to buy up companies, to put capital in. So a lot remains to be seen. Even though our survey showed some negativity for this borrowing base season, I'm not expecting a lot of drama just based off of what we've seen from existing redeterminations that have happened already, and also just market events recently. And so, more to come for sure, but not expecting as much drama as, maybe some had predicted for this redetermination season. And also, just while we're on on the topic of sort of distress in the energy markets, just want to give the audience a heads up that our October updates to our 3 energy bankruptcy trackers will be posted to our website the next couple of days. So please be on the lookout for those. And on the next slide, you can see details for how to find them on our website. You go to our main website address, and on the bottom left-hand side, you'll see a link to access those surveys. One notable item to report, these trackers show that on the upstream side, there were only 3 bankruptcies filed in October, kind of keeping with the trend that the upstream side has actually been somewhat stable for the month of October when it comes to distress and addressing distress. And 2 of those 3 bankruptcies had fairly immaterial levels of debt, either 6-figure or 7-figure levels of debt, compared to the other filings we've seen. The much bigger activity was on the oilfield services side, which had 9 filings, including a few that had $1 billion or more in debt. So definitely oilfield services feeling the pain. Even as we go into recovery mode, the drilling budgets won't be what they were in the past. And so oilfield services certainly going to be feeling the pain pretty hard. And also there was no filing activity on the midstream side as far as our midstream tracker goes for the month of October. However, there were a number of significant upstream oil and gas covenant running with the land decisions that came down from bankruptcy courts in October. And those are expected to generate distress for many midstream companies. If you want to learn more about those, please reach out to Jeff Nichols. He is moderating a webinar on this topic this Thursday at noon Central Time. With that, I'll turn it back over to Jeff.
Thanks, Craig. And I can see that Aaron has rejoined us. So Liz, if you can flip back to that slide where we lost Aaron. Aaron, can you take yourself off mute? And you were in the middle of a great presentation. So I think you can, there we go. Aaron, I think you're on mute.
All right, can you hear me now?
Loud and clear. Thanks.
All right. Sorry about the technical difficulties. I'm dialed back in on my phone, but the show must go on. So back on slide 25, I was talking about the restructuring transactions, and Craig actually, I was supposed to tee him up for some of this, and he ended up teeing me up. So if we take a look at, we talked about the Lillis deal. We take a look at the Bonanza Creek deal that was announced yesterday. This is the one that really kind of headed off a bankruptcy where Bonanza Creek comes in as a part of a restructuring agreement and allows High Point to participate with some of its equity to the upside. You get a little bit of a valuation premium, closer to $12,000 per flowing, and potentially avoid a bankruptcy. But if this process still needs to go, if the exchange doesn't work out, then bankruptcy is an option. But here's one where we talk a little bit about, an activist investor helping get things done, and not an activist in a traditional sense, but a capital partner in Franklin Advisors who owns a significant amount of High Point's debt, who is able to help think constructively with a company and potentially put what is a really positive deal together for both the High Point and Bonanza Creek. And so activist investors, or maybe a better term for that is constructive investors, can help you get something done. And that was one example of that. Certainly the merger of equals with Devon Energy and WPX to combine in a merger of equals is what they called it. This was a $5.7 billion stock and debt assumption deal. The valuation got closer to that $27,500, and if you recall from earlier slides, that was right in the ballpark of where the mid-cap valuation was. And if you think about what this combination of WPX and Devon are able to do, there is some opportunity to make what they touted in their call as a $12 billion enterprise value company. That starts to fall into this large cap market cap, where they were trading at closer to 44 or 45,000 per flowing. And so if you think about buying something at 27 and realizing upside to 44, there's some value to the size and scale should you be able to put those things together. So this merger of equals idea makes a lot of sense. And then you got the small premium acquisitions, looking again at Pioneer and Parsley. Here's one where Pioneer was in this larger cap group, Parsley in the mid cap space, certainly adds, but Parsley was able to have more of a premium valuation because of their cash flow situation. So there's not a whole lot of room on some of these, what would be healthy M&A, which is where I categorize this one, on paying a lot of a premium. And so you're following on with your stock and assumptions, but deals are being considered and thought of in that. So if you take a look at what is my last slide, and these M&A transactions, that bid-ask spread that we've talked about, there is different motivations for getting things done. It could be a capital partner that's not forcing you, but encouraging you to do something. It could be that there's expansion in valuation, and it could be that you just want to get cash in the door, whether those may be. But really, to go back and say good investor relations opens doors, you need to be out there, and this isn't just a public company thing, you need to be out there telling your story. And this goes beyond what we just heard on the conference calls. You got to be out there telling your story, where you are, honestly where you can go. It's got to be consistent and broadly messaged so that you can receive the valuation that's fair for your story, and also have discussions with other capital providers that may be able to help you down the road. A part of that discussion, and it hasn't led to, based on our research, necessarily a premium valuation, but it's certainly something that is top of mind, is this ESG, environmental, social, and governance. Certainly with a presumed Biden-Harris presidency and where we're going already before that, oil and gas needs to be out there telling its story and how it can be a sustainable business model. And we all know, I'm preaching to the choir, that it can be, but it is an investor relations function, and it is something that opens doors. And so it's something that needs to be discussed so that a door can be open and a conversation can be had. The other component to this is also communication with debt holders is just as important as it is with equity holders. There was a common belief that back in the day, and I'll say a year to even 2 years ago, I really just wanted to have a conversation with my equity holders. That's what's driving my equity and my stock price, my valuation. And the debt guys can, we'll have a discussion, but I don't want to see them. And I think now, particularly where we are, those debt holders may become your equity holders, one, and two, they may be able to be in a position to help you have a constructive dialogue with a good path forward. And so that's where I say be open to discussions with non-traditional activist investors, capital partners, and folks that can help you get stuff done. Penn, Virginia is one example of this with Juniper Capital, certainly a private equity firm well known to the energy space, able to come in with some cash infusion and some assets, and also took a board seat. And so they want to have an active role in the management of that company. But that provided a nice path forward. High Point and Franklin, which we already talked about, is in that camp as well. But we've also seen traditional activist groups like Elliott come in on some of these M&A deals saying, hey, we should be getting more. And really, as you think about working with activist investors, and when we talk about clients and doing this work, it really comes down to making sure a company is owning and telling its story, and two, make sure your ears are open and understanding what perspectives are out there. There's a lot of different stakeholders, whether you're headed down a bankruptcy or a traditional M&A or going to be a going concern type of discussion with your shareholders. And so just be open to those dialogues. And so that was really what I had. Jeff, I'll turn it back to you.
Perfect. Thank you, Aaron. Thank you for your coolness under pressure and dialing back in. And believe it or not, I think we're going to be able to cover all of our material just in a different order than we had originally intended, because Fraser has rejoined. And so, Liz, if you can take it to his slide. Fraser, can you hear me?
I can.
Very good. Well, thank you, Fraser, for rejoining. So if you can, I guess, take it from the top, and we have about 10 minutes left.
Okay, sounds good. Good morning, everyone. It's Fraser Murphy. I'm a partner in the restructuring section. We wanted to spend a few minutes this morning talking about Chapter 11 toggle plans, which sometimes are just simply referred to as a toggle feature or broadly as a toggle plan. And really all this means is that it's a plan that provides for two potential outcomes. The first outcome is a sale of substantially all the assets of the debtor, or number two, it's a traditional restructuring of the company's liabilities. And the path that is pursued depends on whether the lenders exercise a so-called toggle right, which shifts the plan from a sale to a traditional restructuring. So to kind of set the scenario, we know that there are active buyers in the distressed oil and gas arena, but the one thing that we often do not know is if the price those buyers are willing to pay is sufficient for the lenders to consent to the sale. And so the traditional way you would test this is to run an out-of-court sale process. You would identify and name a stalking horse bidder at a price that was acceptable to the lenders. The company would then file Chapter 11 to effectuate the sale. And in that case, you have a defined party that's ready to buy the assets at an acceptable price. No toggle feature is needed. But oftentimes, the stalking horse is not identified in a pre-petition marketing process because either there's insufficient interest in the assets or the purchase price is simply not high enough for the lenders to consent to the sale. Maybe the parties still believe a successful auction and sale process can be conducted in Chapter 11, but there's some uncertainty about the purchase price and whether that price will be high enough. And that's the ideal scenario when the parties can use a toggle plan. And so the mechanics would really work like this. Now, to be fair, there's some variations as to how you might do this, but commonly it would work as follows. A Chapter 11 case would be filed. Your first day hearings would proceed as normal. You would have DIP financing order or cash collateral order entered in the case, depending upon the liquidity needs of the company over the course of the Chapter 11 process. Both the DIP financing order and the cash collateral order would contemplate a sale scenario and a traditional Chapter 11 restructuring. And you would see the mechanics of that addressed through various case milestones that the company would be required to achieve to stay on track in the Chapter 11 process. Those case milestones typically, as many of you have seen, would be deadlines for the DIP financing order or the cash collateral order to be entered, deadline for the approval of bid procedures, a deadline for the auction to be conducted and the sale to close, or alternatively on the plan path, there would be deadlines for filing a plan, confirming a plan, and then making the plan go effective. So after or along with the entry of a DIP financing order and cash collateral order, a bid and sale procedures motion would be filed by the company that sets out the procedures under which the assets would be marketed and sold. A Chapter 11 plan would be drafted and filed contemporaneously with that motion or shortly thereafter that provides for both of the two scenarios that I outlined before, either a sale or a traditional restructuring. The sale procedures would then be approved, a marketing process is conducted, and as the bids come in, the company seeks, if possible, to name a stalking horse bidder. Meanwhile, the lenders are coordinating and establishing a reserve price, or the price at which they'd be willing to consent to a sale. And that reserve price would not be communicated to the bidders, as that could obviously hinder efforts to maximize value. But that reserve price is discussed with the company's advisors as part of the general consultation and discussions that would be occurring between the lenders and the company during the course of the process. If a bid ends up emerging that meets or exceeds that reserve price, then the parties would move forward with the asset sale. If, on the other hand, a bid does not come out that meets or exceeds that reserve price, then the lenders would deliver a toggle notice to the company that simply indicates that they do not consent to the sale at the current price and wish to toggle or pivot over to a traditional restructuring. Now, one thing to note here is that the plan is typically very light on any details as to how a traditional restructuring would be achieved. It's very light on details as to how the debt would be restructured, because putting that information out in the public domain obviously could negatively impact the sale process, and it could impact negatively the company's ability to maximize value. So let's look at kind of the pros and cons of the toggle plan or the toggle feature. And really none of these are to suggest that a toggle plan is better than a defined bankruptcy strategy. And, frankly, if you've got a defined bankruptcy strategy, that is better than a toggle plan. A toggle plan is good when there are unknowns that exist related to asset values and the delta between the bid and the ask. But from a company standpoint, the great benefit of a toggle plan is it provides that solid structure of giving the company an exit path from Chapter 11. A company would never want to file Chapter 11 without an exit strategy. And so even though there are many variables inside of a toggle plan, that type of plan at least provides the company with an exit ramp from Chapter 11. It could be through a sale process, or it could be through a restructuring, but it's a defined exit path. For a lender, and from a lender's standpoint, a toggle plan allows for a lender's collateral to be exposed to the market with the potential of a buyer emerging to take the collateral off the lender's hands at an acceptable price. But there's also that added benefit of a backstop in case the sale process fails that allows you to restructure your debt under a traditional Chapter 11 plan, which could enable you to extend that runway to a better sale environment. Now, from a buyer's standpoint, toggle plans are somewhat neutral. One might look at this and you might say, well, why would a buyer expend resources pursuing a purchase of the assets if the lenders can just toggle away from the process? And that's a valid question. But the one thing to point out is that most often in sales scenarios, the lenders almost always preserve their right to credit bid. So when the purchase price does not exceed a threshold that's satisfactory to the lenders will exercise their rights to credit bid. And so the toggle feature is really no different from a lender exercising a credit bid right. And in fact, usually the toggle feature is structured as, from a legal standpoint, is structured as a secured lender's exercise of its credit bid rights. It's just the difference being that the lenders would not actually take title to the assets. Rather, they would simply use the credit bid right as a legal mechanism to toggle to the restructuring. So the last couple of things I would say here is that from a market standpoint, there are two recent cases that have featured this toggle right that Haynes and Boone has been involved in. The first was the Approach Resources bankruptcy case, which was filed in the Southern District of Texas, pending before Judge Isger. That case had a toggle feature and a toggle component of it. A buyer actually ended up emerging and the assets were sold, so the toggle right was not actually triggered there, but it was available to the lenders to the extent that an acceptable sale price was not achieved. And then the second case I would mention is the Ursa Peons case, which is a Chapter 11 case filed in Delaware in front of Judge Shannon. And that sale process is ongoing, and in fact, the auction is scheduled for later today. So whether the toggle is exercised by the lenders in that case remains to be determined, but we should know shortly. But certainly, given the volatility in the oil and gas industry, we would anticipate the continued use of the toggle feature and toggle plans for the foreseeable future.
Thanks, Fraser. That was well done and timed perfectly. I appreciate your flexibility in dialing back in and overcoming our technological issues. So that concludes our program for today. I will mention once more that we do have our midstream webinar on Thursday, midstream midlife crisis. So email me if any of you would like to have the connection information, and we'll look forward to seeing you in a month, the second Tuesday in December. Thanks.